Welcome to the Cardinal Commentary for the Foreign Equity Portfolios. 1 year after falling into bear market territory, the S&P 500 officially entered a bull run in June, rising 20% from mid-2022 lows. It might be the quietest bull run of all time, but the rising tides aren't lifting all boats. The vast majority of returns were due to just 7 high-flying tech companies, while the other 493 were essentially flat. The rise of AI, or artificial intelligence, has pushed up the valuations of companies such as Nvidia, Alphabet, and Tesla by about 50%. Picking the ultimate winners in AI is impossible at this stage. You may have noticed that we don't own any of these companies, but our portfolios are well positioned to benefit from this growing trend. That's because a number of our holdings are leaders in cloud computing and semiconductors, which are the backbones of AI. Applied Materials builds the equipment to make chips faster and more efficient. Broadcom is helping the big tech players design custom chips for their data centers. And portfolio manager Sheila Wilson-Cole says Oracle is building out specialized data center infrastructure to rent out to other companies to run their AI models. A few words of caution, though. It's very early.
AI is certainly getting a lot of news these days, and that's prompted some stocks in particular to go up significantly. It is still early days to see who the ultimate winners are going to be, but it's looking likely that even if you're not directly involved in a business related to AI, that a lot of sectors and businesses will be able to benefit over the long run, but it's still a to be determined story. Oracle, we've held in Cardinal portfolios for quite a while now. It's a great company, high quality, well-managed company in the software application and the infrastructure technologies space. And they've been executing on a plan for the past 5 years in terms of moving more into the cloud services area. And we've really seen over the past couple of years that those investments are bearing fruit, and their earnings are growing significantly, their revenues are up. So that's where that stock has taken off more recently as companies use their services to move into the cloud. So I think it shows in terms of Oracle, we were patient with it initially going back into the 2018, 2019. It delivered decent returns, grew the dividend, but we still like the company, held on to it, and now we're seeing that company really do quite well in terms of its share price return.
Inflation in the US, meanwhile, slowed to 3% in June, the lowest level since March 2021, and edging closer to the Fed's goal of 2%. Portfolio manager Evan Manser says lower inflation will ultimately lead to central banks cutting interest rates.
Inflation is on the way down. We peaked about a year ago in Canada and the US. We're over 9%, and we've seen it come down steadily since then. Right now, what's not talked about as much is you've almost got a tale of two inflations. You've got 2/3 of it, which is actually where the Fed wants it to be, right around that 2% level. And then you got housing. And in Canada, that includes mortgage costs. In the US, it doesn't. It's equivalent rents. And that's still quite high. We have seen, though, the on-the-ground level rents have really trailed down. What people don't look at or talk about much in the inflation data is this is lagging data. So we've got data coming from October last year, and we think that as this data continues to come out, that will come down, and it's going to help bring inflation down, which should cause investors to start looking towards interest rate cuts.
Further good news for the US economy is the job market remains very tight, with unemployment falling to 3.6% in June. 2 companies in our foreign portfolios increased their dividends during the quarter: Medtronic at 1.5%, and United Health Group at a very healthy 13.9%. Even without the tech companies, it has been a strong year to date for our foreign equity portfolios. But where they really shine is over the long term, like 15 and 20 years. And here's the proof. If you invested $500,000 in this portfolio in 2003, it would be worth nearly $2.9 million today, far outpacing what you would have earned by investing in the benchmark. And why do we do all this? Because it works. And that's the Cardinal commentary for our foreign equity portfolios. Thanks for joining us.